Meghan, in some respects, people are saying, look, we may have actually peaked in inflation expectations in particular, and maybe an overall inflation. How do you position for that?
Yeah, I think that's a good point. While we may have peaked, certainly in terms of some of these core year-over-year readings, the question is really going to be, when will the Fed ultimately need to pivot and sound more dovish on the second part of their mandate, particularly unemployment? We think that they've already begun to show signs that they're considering this from their recent commentary over the past couple of weeks or so, and specifically what we're hearing from the minutes, that they're going to be watching how the unemployment picture is evolving as they deliver these hikes. And we think that where inflation ultimately settles when they pause is a really important thing here.
Okay, and it's a really interesting mix, isn't it? The fact that we have this really high inflation, we have really low unemployment, and yet everyone's so nervous about the state of the economy, Meghan. I mean, if we're waiting for unemployment to turn, we might be waiting quite a long time. Does that give the Fed scope to hike for quite a duration?
Yeah, Anna, we think that they're going to deliver at least 2 more 50 basis point rate hikes, but September is going to be an important part here. We think that we may be seeing the bottoming in those weekly jobless claims numbers, which is something that they're going to have their eye on. And over the past few weeks, we've definitely seen the market refocus a bit here on those downside risks coming out of the earnings releases that we've been hearing, which gives us some guidance to basically say here that with the market pricing a path that seems pretty consistent with what the Fed has in mind, peaking perhaps at around 3.5% or so this cycle, that's doing its job and tightening financial conditions.
Has the bond market accurately reflected the possibility of this pause?
I think probably not. While we think a pause is likely in September, that's not necessarily our base case here. But we think that there could be slowing from this 50 basis point increments that they've been delivering to something more like 25 basis points. And again, consider the effects that they're already having on financial conditions, and be very actively monitoring what we're going to be seeing in the labor market, again, on the back of some of these pressures that we've seen already reported in the earnings releases.
Yeah, give us a bit more, Meghan, on where you think the 10-year Treasury, for example, at the end of this year. We were speaking, and we'll just listen into a clip of the conversation. We were speaking to Stephen Major from HSBC a little bit earlier on, and he was painting a picture of something that's quite complex, dependent very much on where the Fed goes. You could get to 2 very different end-of-year yields on 10-year Treasuries. Let's listen.
If they hike with their eyes closed and they carry on doing it into next year, then the 10-year Treasury should be 4%, right? If they take into account that we could have a recession by 2024, they're going to be back at 0 within the next year or so. Therefore, the yield should be below 1%.
So, Meghan, Stephen, just getting to the point there, that dependent on what you think the Fed is going to, how you think the Fed is going to treat fears of slowdown in the global economy, in the US economy, you can get to very different conclusions for the end of the year as to where the 10-year yield is, anything between 4 and less than 1%. Where would you sit on that spectrum?
Yeah, I think that's absolutely correct. Where we're sitting right now is that we think that we've probably already seen this peak in 10-year yields. And this is because the market is already showing some signs of stress here. What's the first thing that investors do when they're worried about the economy? Well, they buy risk-free assets, and that's treasuries. So we think that we're probably going to see a continued decline in back-end treasury rates, particularly the very long end of the curve, 30-year. As we continue to see, pressures and uncertainty around the economic picture here, and again, increased concerns around the stagflation scenario.